Hey everyone, welcome back to Corporate Decoder, the place where we unpack the confusing world of corporate finance. And let me tell you, today's report from Global Interactive Technologies is a wild ride. Prepare for some serious ups and downs, and maybe even a bit of a reversal of fortune to tell you about. Alright, so Global Interactive Technologies, or GITS, as they record on the stock market, just dropped their quarterly report for the period ending June 30th, 2025. And let me tell you, it's a snapshot of a company in a very interesting, let's say, transitional phase. Let's dive straight into the numbers because that's where the real story is. Looking at their balance sheet as of June 30th, 2025, they have total assets of a little over $6.3 million. That might sound like a lot, but compare that to December 31st, 2024, when they had about $6.4 million in assets. So a slight decrease there. Now, what's really catching my eye is their current assets. As of June 30th, 2025, they stand at just under $26,000. That's a huge jump from just under $3,000 at the end of 2024. This spike is mainly due to a massive increase in non-trade receivables, which went from a mere $2,097 to over $14,000. It suggests some significant short-term funding or agreements are in play. On the other side of the ledger, their total liabilities and stockholders' equity balance out at around $633 million for June 2020. What's interesting is their total liabilities have actually decreased from about $668,000 at the end of 2020. This is largely due to repaying some loans, which is generally a good sign for financial health. But here's where it gets a bit complex. Their stockholders' equity shows an accumulated deficit of nearly $39.2 million. That's a big number, essentially, all the money they've lost over time. However, their total stockholders' equity is positive, around $5.79 million, mainly thanks to a significant increase in additional paid-in capital. This indicates they've likely been raising money by selling stock. Now let's talk about how they're actually performing. In the statement of operations, the numbers for the 6 months ended June 30th, 2025 show a net loss of about $1.24 million. That sounds bad, but it's actually a significant improvement compared to the $1.6 million net loss in the same period of 2024. And check this out, their revenue for the first 6 months of 2025 was a whopping $29. Yes, you heard that right, $29. This is up from $0 in the prior year period. This tiny bit of revenue suggests they are just starting to get their new platform feigning up and running. Their operating expenses are where the bulk of their costs lie. For the 6 months of 2025, general and administrative expenses were about $1.24 million, a big jump from about $500,000 in the same period of 2024. This increase is likely due to the investments made in revitalizing their platform. Despite the big jump in operating expenses, their continuing operations loss for the 6 months of 2025 came in at a little over $1.24 million. Now, this might seem like a lot, but remember, the prior year's figures included discontinued operations, which accounted for over $1 million loss alone. So managing their core business seems to be showing some signs of improved focus, even if they're still in the red. The statement of changes in stockholders' equity tells a story of a company trying to rebuild. We see that in early 2025, they did a 1-for-20 reverse stock split. What this means is they reduced the number of shares outstanding significantly, trying to make the stock price look more robust. Then, throughout the first half of 2025, they converted a lot of debt into stock. For instance, on February 17th, they converted $210,000 of debt into 300,000 shares of common stock. They did this several more times, effectively swapping debt for equity. By the end of June 2025, they had over 3.5 million shares outstanding, up from about 2.6 million at the end of 2024. This increase in shares combined with the debt conversions points to a strategy of cleaning up their balance sheet and potentially preparing for future growth or investment. Now let's look at how much cash they're actually using or generating. For the 6 months ending June 30th, 2025, their cash used in operating activities from continuing operations was about $530,000. It's a significant outflow, but better than the nearly $257,000 outflow for the same period in 2025 due to their investments in intangible assets like software. And speaking of cash, their cash on hand at the end of June 2025 was just over $10,000. That's up from a mere $2,052 at the end of 2024. While it's an increase, it's still a very small amount, highlighting the company's tight cash situation and their reliance on continued fundraising. The company's core business is their fanning platform, which they describe as a fan participation-based social media platform for Korean entertainment or K-culture. They acquired Fanning Korea in December 2024, and it seems like the focus is really on making this platform work. This section, going concern, is always a bit of a red flag. As of June 30th, 2025, they have a huge accumulated deficit of almost $39.2 million and a working capital deficiency. They also had an operating loss of over $1.2 million for the period. This all means there's serious doubt about whether the company can keep operating for the next year. They're planning to diversify revenue streams, enter new markets like K-food, and raise more capital, but they admit there's no guarantee these plans will succeed. A key policy here is how they handle foreign currency. Their main operations are in Korean won, but they report in US dollars. This means exchange rate fluctuations can really impact their reported numbers, which they've seen with the won weakening against the dollar in the recent period. They have significant intangible assets, mostly software, valued at almost $4.82 million after amortization. They acquired this software for around $4.94 million. This is a big chunk of their assets, and it's crucial for their fanning platform to perform well for this investment to pay off. Interestingly, they have access to about 19,200 square feet of office space in Seoul at no charge until May 2031. While it's free rent, they did recognize it as a right-of-use asset and have been accounting for the value of this lease. They actually transferred this lease right from a former subsidiary to themselves in late 2024. This section details their stock activity. They had a reverse stock split in January 2025 and then significant issuances of stock due to debt conversions throughout early 2025. This shows the company actively managing its capital structure, trying to get healthier. In 2024, they sold off several subsidiaries like FNS Co Limited and Hanru Bank Coffee Limited. These businesses are now classified as discontinued operations. They reported a gain of over $18.8 million from selling these subsidiaries, which significantly boosted their equity, but also means those businesses are no longer contributing to their ongoing operations. This part about control deficiencies is important. Management admits their disclosure controls and procedures were ineffective. They point to a lack of accounting resources and segregation of duties, mostly due to their small team. While they have extra procedures to ensure the financial statements are fair, this weakness means there's a higher risk of errors going undetected. They're facing a potential administrative fine in Korea related to their IPO funds. They believe they shouldn't have to pay it because they're a US company and held an information session, not a direct solicitation. However, their initial objection was rejected, and they've now filed an administrative appeal. This could have financial implications if they lose. This confirms further debt conversions into equity in February and May of 2025, with loans being exchanged for company stock. This is another example of them shoring up their balance sheet and reducing debt. So, what's my take on Global Interactive Technologies? Well, they are definitely in a rebuilding phase after a lot of restructuring in 2024. The fanning platform seems to be their big hope, but the revenue figures are almost non-existent right now, just $29 for 6 months. That's incredibly low. The company's strategy seems to be focused on raising capital and managing debt, which they've done by selling off older businesses and converting debt to equity. However, the immediate future looks very uncertain. They have a huge accumulated deficit, very little cash on hand, and the report explicitly states there's substantial doubt about their ability to continue as a going concern. While they plan to diversify into new areas like K-food and improve the fanning platform, it's still very early days and success is far from guaranteed. The legal issue in Korea is also a lingering risk. In essence, GITS is a company betting heavily on its fanning platform to turn things around, but right now it's a very high-risk speculative play. They need to show significant growth and revenue generation from fanning very soon to survive. Alright, that's our deep dive into Global Interactive Technologies' latest financial report. What do you think about their strategy and those tiny revenue numbers? Let me know your thoughts in the comments below. If you found this breakdown helpful, give this video a thumbs up and subscribe for more plain English analysis of corporate filings. And hey, join our Discord community for even more discussions. The link is in the description. Thanks for watching, and I'll see you in the next one.